Friends, welcome to your channel. Today we are going to discuss about leverage ratios, which is a powerful tool used by investors, analysts and businesses to assess the financial health of a company. Today we will cover the major types of leverage ratios, how to calculate them and what they reveal about a company's use of debt. So what are leverage ratios? Leverage ratios measures a company's debt relative to its equity, assets or earnings, providing insights into how much financial leverage a company is using. In simple terms, these ratios help you understand how much a company relies on borrowed money to finance its operations. First, let's break down the debt to equity ratio, which is calculated as total debt upon total equity. It is one of the most commonly used leverage ratios. This ratio compares a company's total debt to its shareholder equity, showing how much debt the company uses for every dollar of equity. A higher debt to equity ratio means a company is using more debt to finance its operations, which could increase financial risk. Generally, a ratio below 1 is considered conservative, while ratios above 2 indicates higher leverage. Next is the debt ratio, which is calculated as total liabilities upon total assets. It measures the proportion of a company's assets that are financed by debt. This ratio assesses a company's overall risk profile. If a company's debt ratio is above 50%, more than half of its assets are financed by debt, which increases financial risk, especially in the economic downturns. Now, let's have a look into the interest coverage ratio, which is calculated as EBIT upon interest expense. It helps us understand how easily a company can cover its interest expenses with its earnings. A higher interest coverage ratio means the company is able to meet its interest obligations. So, seeing the example which we can see in the screen, the interest coverage ratio would be calculated as 42,70,000 divided by 7,25,900. Mention in the comment below what's the interest coverage ratio calculated by you. Finally, let's look at the fixed charge coverage ratio. This ratio extends the concept of interest coverage by including other fixed obligations such as lease payments to give a broader view of the company's ability to meet fixed expenses. The fixed charge coverage ratio is calculated as EBIT plus fixed charges upon fixed charges plus interest expense. So, as you can see in the screen, the fixed charge coverage ratio is calculated as EBIT plus the total fixed charges divided by total fixed charges plus interest expenses. So, to conclude, as you can see, the leverage ratios are essential for understanding a company's financial risk and stability. By analyzing these ratios, you can make better decisions whether you are an investor, lender, or a business owner. Remember, each ratio tells part of the story. Always consider the company's industry, historical performance, and other financial ratios before making decisions. If you found this video helpful, don't forget to like, subscribe, and share for more such finance insights. See you next time. Till then, bye bye.